Preparing for a commercial banking portfolio manager interview? You've reached Candy Mentor, and this video is for you. We'll walk through 15 key questions you're likely to face. For each question, you'll see a sample answer, followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. What does a commercial banking portfolio manager do? A commercial banking portfolio manager is the credit owner after origination. I manage the risk return of a book of business, underwriting renewals, monitoring covenants, reviewing financial performance, maintaining risk ratings, and spotting deterioration early. I partner with relationship managers, but my judgment stays independent. The goal is not just to avoid losses, it is to support good clients with the right structure while protecting the bank's capital and reputation. While answering, focus on credit ownership, portfolio monitoring, renewals, risk ratings, covenant tracking, and partnership with relationship managers, while maintaining independent credit judgment. Question 2. How do you apply the 5 C's of credit in a commercial loan review? I use the 5 C's as a checklist, not a substitute for judgment. Character is willingness to repay, capacity is cash flow, capital is borrower support, collateral is secondary repayment, and conditions are industry and economic context. In practice, capacity drives most C&I decisions, but weak character or poor conditions can override strong ratios. The framework helps me explain credit risk consistently to approval committees. Make sure to cover character, capacity, capital, collateral, and conditions. Then explain that the framework is a practical checklist rather than a mechanical scoring model. Question 3. Walk me through how you would underwrite a new commercial and industrial loan. I start with the purpose of the loan and the primary repayment source. Then I spread 3 years of financials, normalize EBITDA or cash flow, analyze leverage, coverage, working capital, and trends. I review management, ownership, customer concentration, industry conditions, and collateral support. Finally, I recommend. In your answer, talk about borrower purpose, financial statement spreading, cash flow analysis, leverage, collateral, management quality, industry risk, repayment source, loan structure, and approval memo conclusions. Question 4. How do you assess a borrower's ability to service debt? I focus on sustainable cash flow, not just net income. For many middle-market borrowers, I start with EBITDA, adjust for owner compensation, one-time gains or losses, and required capital expenditures. Then compare cash flow to scheduled principal, interest, taxes, and distributions. I also stress revenue, margins, and rates. If a borrower covers debt only in a perfect year, the structure is too thin. Be sure to mention cash flow over accounting profit, EBITDA adjustments, fixed charge coverage, debt service coverage, sensitivity analysis, working capital needs, and recurring versus one-time items. Question 5. Which financial statement trends matter most when monitoring an existing commercial borrower? I look for changes that affect repayment capacity. Revenue growth is positive only if margins and cash conversion hold up. I track gross margin, EBITDA margin, leverage, fixed charge coverage, liquidity, receivable days, inventory turns, and payable stretch. I also compare actual results to budget and prior underwriting assumptions. The key is pattern recognition. Small negative movements across several metrics often matter more than one isolated variance. While answering, focus on revenue growth quality, margins, leverage, liquidity, working capital turnover, customer concentration, covenant cushion, cash conversion, and whether trends match the borrower's story. Question 6. A borrower requests a line increase, but margins have declined for 2 years. How would you evaluate the request? I would not treat the request as an automatic no, but I would slow down and understand the margin decline. Is it pricing pressure, labor inflation, mix shift, or temporary input costs? I would refresh cash flow, borrowing base availability, covenant cushion, and projections under downside cases. If the line increase funds profitable growth and collateral supports it, I may recommend approval with tighter monitoring, revised covenants, and appropriate pricing. Make sure to cover reason for margin pressure, borrowing need, updated projections, collateral support, covenant headroom, repayment capacity, pricing, and whether structure should tighten before approving exposure growth. Question 7. What makes a good financial covenant package for a commercial loan? A good covenant package protects the bank without setting the borrower up to fail. I prefer covenants tied to the repayment source, such as senior leverage, fixed charge coverage, minimum liquidity, or borrowing base availability. The levels should be based on historical volatility and downside forecasts, with reasonable cushion. Covenants should trigger early conversation, not immediate crisis. If they are irrelevant or too loose, they do not manage risk. In your answer, talk about covenants as early warning tools, not punishment mechanisms, including leverage, fixed charge coverage, liquidity, borrowing base controls, reporting frequency, and realistic headroom. Question 8. How do you decide whether to downgrade a borrower's risk rating? I downgrade when the borrower's risk profile has changed, not merely because one quarter was weak. Triggers include sustained EBITDA decline, covenant default, liquidity pressure, stretched payables, missed reporting, collateral deterioration, or management instability. I compare the facts to the bank's rating definitions and probability of default indicators. The important part is being timely and well documented because delayed downgrades hide risk and reduce workout options. Be sure to mention objective and judgmental factors, sustained performance deterioration, covenant breaches, liquidity stress, management issues, industry pressure, collateral erosion, and documentation of rating rationale. Question 9. What do you include in an annual review for a commercial banking relationship? An annual review should refresh the full credit view. I update financial spreads, cash flow, leverage, coverage, liquidity, and covenant compliance. I review exposure across loans, deposits, treasury products, letters of credit, and unused commitments. I reassess collateral, guarantors, industry outlook, management performance, and risk rating. Then I make a clear recommendation: renew, modify, reduce, or exit. It should not be a box-checking exercise. While answering, focus on updated financial analysis, relationship exposure, compliance status, risk rating validation, collateral review, guarantor support, industry outlook, pricing adequacy, and recommendation. Question 10. How would you handle a borrower that has breached a financial covenant? First, I would understand why the breach occurred and whether it is temporary or structural. I would request updated financials, projections, liquidity detail, and a management action plan. If repayment capacity remains intact, a waiver or amendment may be appropriate, usually with fees, revised covenants, and tighter reporting. If the breach signals deeper weakness, I would escalate early, preserve bank rights, and consider reducing exposure or transferring to special assets. Make sure to cover determining cause and severity, temporary versus structural issues, updated forecasts, waiver or amendment analysis, sponsor support, reservation of rights, and enhanced monitoring. Question 11. How do you think about loan structure in commercial banking? Structure should match the use of funds and repayment source. A working capital need fits a revolving line tied to receivables and inventory. Equipment financing should amortize with the asset's useful life. Acquisition debt needs cash flow coverage and tighter leverage controls. I also consider tenor, collateral, guarantees, covenants, and pricing. Good structure reduces risk by forcing the loan to self-liquidate in line with the borrower's cash cycle. In your answer, talk about matching loan type to purpose, source of repayment, amortization, tenor, collateral, covenants, guarantees, pricing, and risk-adjusted return. Question 12. Explain how a borrowing base works for an asset-based revolver. A borrowing base limits revolver availability to a percentage of eligible collateral, usually receivables and inventory. For example, a bank might advance 80% on eligible AR under 90 days and 50% on eligible inventory. Ineligible items include aged receivables, related party balances, foreign receivables, or obsolete stock. Borrowing base certificates and field exams help monitor collateral quality. It controls exposure, but cash flow and management still matter. Be sure to cover eligible receivables and inventory, advance rates, exclusions, collateral reporting, availability, over-advances, audits, and why borrowing bases reduce but do not eliminate credit risk. Question 13. When are personal or corporate guarantees important in a commercial credit decision? Guarantees matter most when ownership is closely held, collateral is limited, or the bank needs stronger alignment. A personal guarantee tells me the owner has skin in the game, but I still evaluate enforceability and actual liquidity. A corporate guarantee can be valuable if the guarantor has independent cash flow and assets. I never treat a guarantee as the primary repayment source. It is support behind a sound credit. While answering, focus on alignment of interests, secondary support, owner commitment, enforceability, guarantor liquidity, limitations, and why guarantees do not replace repayment capacity. Question 14. How would you monitor risk across an entire commercial loan portfolio, not just one borrower? At the portfolio level, I look for concentrations and migration. I track exposure by industry, geography, borrower size, collateral type, and risk rating. I monitor past dues, covenant breaches, exceptions, criticized loans, utilization spikes, and declining deposit balances. Stress testing helps estimate loss under rate, margin, or revenue shocks. The goal is to identify themes early, so the bank can adjust appetite, pricing, structure, or reserves. Make sure to discuss concentration limits, risk rating migration, covenant exceptions, industry exposure, criticized assets, past dues, utilization trends, stress testing, and portfolio-level reporting. Question 15. How do you balance supporting relationship managers with maintaining credit discipline? I see the relationship manager as a partner, not an opponent. My job is to help win good business safely. I try to explain credit concerns early, offer structural alternatives, and separate deal issues from borrower issues. If risk is acceptable, I support the transaction. If it is not, I say so clearly and document why. Strong portfolio managers protect the bank while still being commercially practical. In your answer, talk about partnership, clear communication, independent analysis, risk-adjusted solutions, escalation when needed, and avoiding both excessive conservatism and sales-driven credit compromise. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.